Chapter 2 focus on how to record different types of business transactions. We'll also learn how to analyze different types of business transactions. So you ready? Let's go. When you think about a business transaction, this is any event that would change a firm's economic resources. Is referred to as being a business transaction, whether it is selling a product, providing a service, buying inventory or supplies, paying rent or paying your employees. These are all examples of different types of business transactions. Our job in accounting is to analyze and record these different types of business transactions. One way to record these examples, such as binary equipment, is to use what's called the fundamental accounting equation. This is an equation that shows the relationship between what's known as assets, liabilities, and owner's equity. When we look at the fundamental accounting equation in totality, the equation says assets equal liabilities plus owner's equity. The accounting equation must always be in balance. In order to utilize the accounting equation, you must first understand what are assets, what are liabilities, and what does owner's equity represent. When you understand the definition of these terms, you can then utilize the accounting equation to record your different types of business transactions. So let's begin with assets. Assets are things of value that are owned or controlled by a business organization. Again, assets are things of value that are owned or controlled by a business organization. If you think about your place of employment, the company may own the actual building, computers, automobile, land, inventory. Those are all examples of different types of assets, things of value that are owned or controlled by a business organization. When you think about liabilities, these are the debts or obligations of a business. Again, the debts or obligations of a business. So if a company owes some other company, then they have what's known as a liability. Think about yourself. Maybe you have credit card debt. That's a liability. What about student loans? That's a liability. You got a car note? Yep, that's a liability. A mortgage payment? That's a liability. You owe your parents money? That's a liability as well. So anytime a company owes another company or individual, that's known as a liability. And our job in accounting is to record and keep track of the different debts or obligations of a business organization. The last portion of the accounting equation is a section known as owner's equity. This is a term that's used by both sole proprietorships and by partnership. This section shows the owner's financial interest in his or her business. So when you decide to start your own business and you make an investment into your business, you might invest cash into your business. What you're doing is increasing your owner's equity, or you're increasing your financial interest into your business organization. Owner's equity is also referred to as the net worth of the owner. In order to use the accounting equation, you must understand what assets represent, what are liabilities, and what is owner's equity. Let's go over a few more terms, and we'll then go through some actual business transactions and record them onto the accounting equation. Revenue is a term that is often used. It refers to an inflow of money or other assets that result from the sales of goods or services or from the use of money or property. So basically, revenue has been earned. There are two main sources for earning revenue. It either comes from selling of goods or from the providing of an actual service. I want you to think about your place of employment. How does your employer earn revenue? Do they provide a service? Do they sell a product? Or it could be the combination of the two. You can also earn revenue from the actual use of money or property. So when you put your money into the bank and you earn interest, you're earning what's known as interest revenue. Or if you have property that you're renting out, you have what's known as rental revenue. In accounting, revenue is also referred to as income. Sometimes they may call it service revenue, or they may call it service income. From an accounting perspective, revenue and income, those terms are synonyms. The next word we look at is an expense. An expense is an outflow of cash or the use of other assets or the incurring of a liability. In other words, certain expenses must take place in order to earn revenue for the business organization. Now, you heard the phrase, in order to make some money, you got to do what? That's correct. So in order for us to earn revenue, certain expenses must take place. So again, focus on your current employer, previous employer, future employer. And the question was asked again, how does that employer earn revenue? It either comes from providing some type of good or service to the actual clients. Now, in order to earn this revenue, certain expenses must take place, whether it's paying rent expense, advertising, paying the employees, insurance. These expenses must incur in order to earn revenue for the business organization. Now let's take a look at the accounting equation that says assets equal liabilities plus owner's equity. What you would do is list the different type of assets involved in your business transaction. So if an asset involved cash, you will have a cash account listed up under assets. If it involved accounts receivable, which we'll talk more about, you will have a separate account for account receivable. Maybe it involves your supplies account. So you have a separate account for supplies, or maybe you bought equipment. So you're going to have a separate account for equipment. Now, these are all asset accounts. However, they are a different type of assets. And each asset account is listed separately on what's known as the fundamental accounting equation. Under your liabilities, you will have different types of liability accounts. The account you want to refer to initially is an account title known as accounts payable. Again, the account title is known as accounts payable. This account represents debts that a company owes to its creditors. When companies buy from other companies, typically they do not pay cash or front for those products or services. They buy things what we call on account or on credit. meaning that they receive the products now and they're going to pay for it at a later date. We use the accounts payable account to represent the debts that a company owes to other business organizations. Now, under your owner's equity section, which shows the owner's financial interest, we want to focus on 3 different types of account: capital, revenue, and expenses. We talked about revenue expenses already, so let's talk about capital. Whenever the owner makes an investment into his or her company, it goes into the owner's capital account. So if the owner invests $10,000 into their own business, then $10,000 will go into their owner's capital account. In terms of a partnership, you're going to have 2 or more owners. They're each going to have their own separate capital account. So you may have Smith capital account as one owner, and hey, you may have Reed's capital account as a separate owner. And if that was the case, what you would see would be 2 separate capital accounts listed on the account equation to show the investments made by each owner of the business organization. Now, part of the owner's equity section, these 3 accounts will determine the amount of your owner's equity. We're going to add any investment made by the owner, showing their capital account, plus any revenue we've earned by providing goods or services, and then subtract out any expenses that it took place in order to earn revenue for the business organization. We're going to come back with a second video that will show us how to use this equation to record our different types of business transactions.